It's early 2016. You've just managed to save £10,000. It feels like a lot of money, because it is. And now you face a fundamental choice. Do you lock it away in the financial equivalent of a steel vault, a high-yield savings account, where it's safe, secure, and insured? Or do you put it to work in the powerful, but unpredictable, engine of the American economy? An S&P 500 index fund. This isn't just a theoretical question. It's a decision that millions of people make every year. So let's follow that £10,000 down these two separate paths for 10 years, from the start of 2016 to the end of 2025. We'll use the real numbers, the real volatility, and the real-world results to see where each path leads. Let's imagine two people. We'll call them Sarah and Ben. Both start with £10,000. Sarah chooses safety. She finds the best high-yield savings account she can, offering a rate that back in 2016 was around 1%. Ben, on the other hand, decides to embrace the risk for a shot at higher returns. He invests his entire £10,000 into a low-cost S&P 500 index fund. For the first couple of years, the story unfolds as you might expect. Sarah watches her account tick up slowly but surely. By the end of 2016, she's earned about £100 in interest. It's not exciting, but it's positive. Ben's journey is more dramatic. The market returns a solid 9.5% in 2016. His £10,000 is already nearly £11,000. Then comes 2017. The S&P 500 has a fantastic year, soaring over 19%. Ben's initial 10 grand is now worth more than £13,000. He's feeling like a genius. Sarah's account, meanwhile, has earned another £100 or so. She's happy her money is safe, but she can't help but feel a twinge of envy. But the market always has a lesson in humility waiting around the corner. 2018 arrives, and the market stumbles. The S&P 500 ends the year down more than 6%. Ben watches as his account loses over £800. For the first time, he has less than he started the year with. This is the risk he signed up for, but seeing it in black and white is unnerving. Sarah, meanwhile, feels vindicated. Her account balance only went up. The safety she chose feels comforting, like a warm blanket during a storm. This is the psychological battle of investing. Ben has to fight the urge to sell, to cut his losses and run for the safety of a savings account like Sarah's. But he holds on, remembering that his time horizon is 10 years, not one. His patience is rewarded. 2019 is a phenomenal year for the market, roaring back with a nearly 29% gain. That single year adds thousands to Ben's account. Then, despite the chaos of 2020, the market still manages to climb over 16%. 2021 is even better, with a gain of almost 27%. Ben's initial £10,000 is now looking like a truly substantial sum. Throughout this period, Sarah's savings account interest rates have barely budged. They're still hovering in the low single digits. Her money is growing, but at a snail's pace. She's earned a few £100s, while Ben has earned tens of thousands. Then comes 2022. It's a brutal year. Inflation is surging, interest rates are climbing, and recession fears are everywhere. The S&P 500 gets hammered, falling nearly 20%. It's the worst year of the decade for Ben. A huge chunk of his gains from 2021 vanishes. The temptation to sell is stronger than ever. But something interesting is happening on Sarah's side. As the Federal Reserve raises interest rates to fight inflation, the APY on her high-yield savings account starts to climb. For the first time in years, she's seeing rates of 4%, maybe even 5%. Her slow and steady approach is suddenly paying her a much more noticeable return. The market, however, proves its resilience once again. 2023 and 2024 see strong rebounds, driven by corporate earnings and excitement around new technologies like artificial intelligence. Ben's account not only recovers its 2022 losses, but pushes to new all-time highs. So now, let's fast forward to the end of our 10-year experiment, the close of 2025. Where do Sarah and Ben stand? Sarah's £10,000, placed in a high-yield savings account, has grown. She never lost a penny of her principal. Factoring in the fluctuating interest rates over the decade, starting low and ending high. Let's use a generous average and say her account grew to about £12,800, a 28% gain. Safe, predictable, and positive. Ben's £10,000 invested in the S&P 500 has had a wild ride. It saw dizzying highs and gut-wrenching lows. But after 10 years, based on the average annual return of about 14.8% during that period, his initial investment has ballooned to approximately £39,600. That's nearly 4 times his initial investment. On the surface, there's no contest. Ben is the clear winner. But this is only half the story. We haven't talked about the silent thief that affects both of them: inflation. Inflation is the rate at which the cost of living increases, and it reduces the purchasing power of your money. A dollar today doesn't buy what it did a year ago. To find the real return, you have to subtract the effects of inflation. Let's say inflation averaged about 2.5% per year over that decade, though we know it was much higher in recent years. Sarah's savings account earned an average of maybe 2.5%. When you subtract the 2.5% inflation, her real return is essentially zero. Her £12,800 at the end of 2025 buys roughly the same amount of goods and services as her £10,000 did back in 2016. She hasn't lost purchasing power, but she hasn't gained any either. Her money has essentially just treaded water for a decade. Now let's look at Ben. His nominal return was a whopping 14.8% per year. After we subtract that same 2.5% for inflation, his real return is still over 10% per year. In terms of actual purchasing power, his £10,000 grew to about £26,200. He didn't just preserve his wealth, he significantly increased his ability to buy things in the real world. And what about fees and taxes? Sarah paid no fees, but her interest was taxed as ordinary income at her highest marginal tax rate. Ben paid a tiny fee on his index fund, probably less than 0.1%. And when he eventually sells, his gains will be taxed at the lower long-term capital gains rate. This further widens the gap in their real, take-home returns. The story doesn't end there. There were lost decades, like from 2000 to 2009, where the S&P 500 actually finished lower than it started. Historically, there's about a 7% chance that the stock market will have a negative return over any given 10-year period. In those rare cases, Sarah's slow and steady approach would have absolutely won. That 7% chance is the price of admission Ben pays for the other 93% of the time when the market's potential for growth is unmatched. So, what's the takeaway? Is the savings account a mistake? Absolutely not. Sarah's strategy is perfect for its intended purpose: short-term goals and emergency funds. If you need money for a house down payment in 2 years, or to cover 6 months of living expenses if you lose your job, you cannot afford the risk of a 20% market downturn like the one in 2022. For that, you need the safety and liquidity of a savings account. Its job isn't to create wealth, it's to preserve it and keep it accessible. Ben's strategy is for long-term goals: retirement, wealth building, money he won't need to touch for at least 10 years or more. Over long stretches, the market's upward trend has historically smoothed out the terrifying drops and rewarded those with the discipline to stay invested. The volatility isn't a flaw in the system, it's the source of the returns. Ultimately, the choice between the S&P 500 and a savings account isn't about which one is better. It's about aligning your strategy with your timeline and your tolerance for risk. The real lesson from our 10-year story is to understand what you need your money to do. Do you need it to be a fortress, protecting what you have for the near future? Or do you need it to be an engine, powering your growth for the distant future? Answering that question is the first and most important step in any financial journey. Thank you for watching another Money Mad video. If you're looking for a new savings account or even an investing account, check out the affiliate links in the description below. You will be supporting this channel with no extra cost to yourself. Subscribe, stay focused, and remember to stay money mad. See you in the next video.